This is InvestTalk, independent thinking, shared success.
Our main focus point is about the fact that high yield savings accounts the yields are falling. We know the Fed has cut rates a few times as we closed out 2024, and there still is a decent chance they'll cut 1, 2, maybe 3 times this year. And that will ultimately, once again, feed into the yield you're going to get on super safe short-term investment vehicles like high yield savings accounts. Now, right now, you can still get about 4% on a high yield savings account. That's much higher than roughly 43 basis points that you're getting on the average savings account. I think Chase is still paying 1 basis point to savings accounts. And so it just makes a lot of sense if you're trying to park safe cash into these type of vehicles. Now, there are other options, though, as well. Now, they can be a bit more complicated, a little more difficult to access, but really not that hard, especially for those that have brokerage accounts, have investment accounts already set up somewhere, whether that's at Schwab or Fidelity or E-Trade or some broker. You can go buy treasuries. We do that for clients that are, we're trying to get the best yield on cash, and we're not trying to take any much duration risk or much credit risk. Buy treasuries directly, and you can still get short-term treasuries yielding in the high 4s. Okay, and so that's something that you have to consider if you have those type of taxable accounts. Remember, the interest on treasuries is state tax free. So that's another benefit as well, especially if you're in a high tax state. The current Fed funds range is right around 4.25, 4.5. And so you can get treasuries, like I said, in the short term, kind of right around that mid 4s. And so higher than the 4 you're going to get on a lot of high yield savings accounts, but still pretty healthy, right? And still down from where we were just a few months ago. Now, you can also buy ETFs. There are ETFs that invest in treasuries as well. It's another simpler way, especially if it's a lower dollar amount. Remember, if you're buying a bond, you need $1,000 to buy one bond. And so if you're only trying to put a few $100s together to work, ETFs can be helpful as well. There's a lot of good, very, very short-term, low-duration treasury bond ETFs still yielding around that 4.5% rate. So you can pick up a little bit extra yield by entering the treasury market. Now, what you have to remember, though, is that anything that's short duration, like a high yield savings account, like short-term T-bills, the rate's variable, meaning it can go up and down based on Fed policy. And you've already seen that with a lot of these, including Goldman Sachs and Apple, cutting the rate that they're paying on their cash that you deposit with them. And so the question comes, do you want to take some duration risk? We've talked about not taking a lot of duration risk, buying TLT, for example, right? 30-year treasury bonds. You don't want exposure to that. But do you want to go out maybe a year or 2 years, maybe up to 3 years? And then you can buy CDs. You can buy what we do for clients. We buy corporate bonds yielding much, much more. You're taking some credit risk there, but I still think in some instances that's a good idea as well. So a lot depends on your time frame. If you don't need the money in the next, call it 3 to 6 months, going out and buying a little bit longer duration in CDs or bonds, that can make sense as well. Now, if you get beyond, say, the 5-year mark, then you want to start thinking more about riskier investments, whether that's real estate, whether that's equities, commodities, etc. That's where you have time horizon to see through volatility. And that's ultimately what we try to do with our clients when we're breaking down their financial plan, building out where more of their money should be allocated. Retirement money, longer term, obviously, but it's usually a 3 to 6 month number of their 3 to 6 months of expenses that should be in some sort of super safe investment, like a high yield savings account, like short-term T-bills, et cetera. And then we allocate money for that. Beyond that, that emergency fund, that's once again when you should start taking a bit more risk. Now, one thing you have to realize is that typically, even though it sounds good, high yield savings account, 4% sounds a lot better than we're getting, just a handful of years ago. It's still not performing as well as other assets. And in many instances, depending on your lifestyle, it may not be keeping up with inflation. And so you could be eroding your purchasing power, even though it looks good nominally, 4% yield, it still may not be keeping up with inflation, especially if inflation reaccelerates, which we're getting signs of that as we begin 2025. And so make sure you're not storing too much money in these high yield savings accounts. Make sure you consult with your financial planner, financial advisor, even your CPA and tax advisor to figure out which is the best account for you that fits your overall financial plan. If you don't have one and your financial life is a bit more complex, where you have a home, you have maybe dual income, you have kids, you have IRAs and 401ks. This is a situation where you probably want to build out a financial plan and have a path forward, know what things are going to look like in 3, 5, 10 years, so you can know how much you should allocate to those high yield savings accounts versus more risky assets like equities.
Hi, this is Andrew from New Hampshire. I'm curious on your take on Adobe. Caught my attention where it had a downdraft in the stock price due to earnings not meeting expectations, but valuation to me seems like it might be a good time to jump in. Would love your perspective. Thanks.
All right, looking at Adobe, and this is down pretty dramatically from its 52-week high, which is at $638. Now we're down to $419, down 34% from its 52-week high, but making a lower high from where it was in December of 2021 at over $700 per share. So the general trend since then is lower, and I think the multiples are coming down as well, and starting to become a bit more reasonable when it comes to its valuation, but still elevated. You have price to sales around 9. That's typically pretty extended. Enterprise value to EBITDA is around 22, which isn't near its lows of what it typically bottoms out closer historically to in the low teens, call it, and we're still at 22. So I still think there's some potential downside. I like that you are looking at a company like this that has a good economic moat, good profitability, and is certainly a good business. Return on equity at 37%, free cash flow at $7.8 billion, but it's still a $184 billion market cap. So you're not talking about a very strong free cash flow yield, still under 2%. And I would want that probably closer to 4%, 4 or 5% for me to be excited to jump into this name. So I like what you're looking at, but the technicals and the fundament and the valuation still leaves a lot to be desired. It is at now near a 52-week low. Actually, yeah, it is at a 52-week low pretty much. And so I think this doesn't find support until about 375, 360 in that range. That's where I might start a position, but I wouldn't be buying it quite yet because I do think it does get down into the mid 300s. And at that level, that's where I would be interested to start. But ultimately, I don't think it's a true value until it gets below 300 per share. So still ways to go. I like that it's on your watch list, but I'd be patient on Adobe. Thanks for the call.
Hey, how's it going? This is Justin calling from Okinawa, Japan, and I'm calling about Realty Income, ticker symbol O. I'm looking at building a position to supplement income just for the coming years, and like how it's grown its dividend over the past 30 years, so it doesn't feel like chasing yield or anything like that. But I do see that the principal is down 11% over the past 52 weeks and 27% down the last 5 years, so well below its moving averages. I'm not sure if it's a good support level or just a concerning downtrend. So higher interest rates, I know, and higher for longer talk is not helping. Just calling to get your opinion on that. Also, the PE ratio being 50 seems kind of ridiculous, so maybe you can shed some light on that as well. Any insight would be a great. Happy New Year to you both, and I look forward to your input as always.
All right, looking at Realty Income. This is a REIT that mainly owns retail properties. Talking about regional and national retail chain operators, 50 states. It's one of the largest REITs that is out there. I'm not seeing what you're saying with forward with P ratio around 40. I remember looking at funds from operation, which this year expected to be $4.39, up from last year's full year expected to be $4.16, and it's at $52.50 at the close today. Closed yesterday, right? Market wasn't open today, but that's low teens multiple. I have no issue with that on the valuation front. Really, I think the worry is just more the type of properties that they own. Now, the good thing is most of these are freestanding, single tenant, triple net lease properties, which means that you're talking about McDonald's, Starbucks, really tenants that are large and strong. And so, and in strip malls and things like that. And those tend to be better than, the big malls. So I like the type of retail space that they own, even though retail generally is weak. Now they have started to add industrial, gaming, office, manufacturing, and distribution properties as well. So starting to diversify a bit, which I like that. But the biggest issue is the overall trend in the stock, and especially compared to the rest of the REIT industry, certainly has been much weaker. And so I don't like the chart. I think this is likely headed lower. It is showing a bearish pattern. But this gets back into the mid to low 40s, excuse me. Now it's at 52. That's an area that I would pick up Realty Income. So what I would do, maybe sell some cash secured puts down at those levels. I think that's a good idea on this type of name, but definitely a solid REIT. I wouldn't be doing it because of the yields. I would be doing it because of the type of properties that they generally own. In fact, they are beginning to diversify their business a bit more. So for that reason, I would continue to have it on my watch list, but I probably wouldn't buy it until it gets to the mid 40s. Thanks for the call. Now we have, you probably noticed that we have answered questions submitted via our YouTube channel. And these are questions that are put in the comment section. So let's handle one of those now. Rowdy 1234568 says, "Hey, InvestTalk, what do you think of HIG? I would like to sell puts at 100. What do you think?" So this is Hartford Financial Group, and this is actually a name that we own for clients. HIG is the symbol. And what does Hartford Financial Group do? They offer group life, group disability, property, and casualty insurance products here in the US. So well diversified. Earnings in 2017 were $2.74. Last year, for full year, once they announced Q4, expect to be $10 and a penny. And this year, full year, expect to be $11.62. So basically, we like it, right? We like that trend in earnings, just a very strong, strong business with good profitability. Return on equity is 19%, not growing dramatically. You look at revenue growth last quarter, 9%. And over the last couple of years, it's kind of averaged around that 10% rate. But profitability last year was up 13%. The year before that was up 17%. This year, profitability is supposed to be up 16%. So this is one of those names where it's not growing 30, 40, 50% and not super exciting business, but it's a consistent business that continues to grow. And we really like those. And you're talking about $109 stock. And it's supposed to make $11 next year, or this year, excuse me, plus. You're talking about a single digit forward-looking P ratio. We like that. With a strong return on equity, with a strong balance sheet. There's just so much to like here, and that's why we own it. Price to book is only at 1.9 times. Enterprise value to EBIT only at 4 times. So just a strong value. And I would selling puts at 100. I think that's a pretty good idea. Thanks for the question.
I've got a question for you. This is Craig from the mountains outside Seattle. I am cash flowing a shop on my property that's going to cost about $150,000. I've already got about 80 of it cash flowed without having to cash anything out, but I intended to cash out investments for it anyway. So my question is, I've got about 70,000 in RSUs through my work, and I've also got about 300 grand in a brokerage account. My thought is to use the RSUs first, since they're already part of my adjusted gross income, and parts have already been pulled out for taxes. I just want to know if that's the right approach. It should cover the rest of the build without having to touch my brokerage. So just wondered your thoughts on that, and if I'm thinking the right way or if I'm missing something. Thanks so much.
Well, that depends on the broad exposure of your investments. It's hard for me to say because I don't know what company the RSU is on. I don't know what your other brokerage account looks like. Is that a large percentage, 70,000, a large percentage of, well, you said you had 300,000 elsewhere. So, that's not a dramatic allocation, but is that all the liquid assets that you have? I'd imagine you might have 401ks, other investment accounts as well. So 70,000 doesn't seem like a lot, but maybe you're overweight to that industry itself. And then you have to ask, is that the right position that you want to cut? I would just look at that as like a part of your overall positions within your taxable investment accounts. So, if you want to run a portfolio review, I encourage you to head over to our website, investtalk.com, and complete that. And we can kind of talk about it, what makes sense for you and these RSUs and what you need this cash for. So, it's always hard to give specific advice without looking at that big picture. It's obviously what we do for clients, it's what we do on our portfolio reviews. And so I would encourage you to complete one of those so that I can give you a more specific answer. Thanks for the call. Now let's talk a little bit about the debt ceiling that is coming up. And the Republicans really have the power here in the debt ceiling fight. But it's part of many priorities that they have, from tax cuts, right? With the Tax Cuts and Jobs Act from 2017 expire this year. And certainly that bleeds into the debt situation and the broader fiscal situation as a country. There's the border, there's energy policy, and potential spending cuts with Doge. And, I think the other question, that was actually a emergency fire warning on my phone. So basically, they have a lot on their plate, and a debt ceiling will prevent them from enacting a lot of their priorities. And so the big question is, once again, this is infighting within the Republican Party. Some are very fiscally conservative, a traditional Republican, whereas others, maybe on the MAGA side, maybe would like to see spending cuts, but they want still spending on the border, for example. They still want tax cuts, okay, for the middle class. So they each have their priorities, and there's infighting, and ultimately there needs to be an agreement in addition to raising the debt ceiling. And then the question is how much do they raise the debt ceiling? Is it just to kick the can down the road a couple of years? Is it to kick the can down the road to the next administration, which may be a Democratic administration potentially, right? You don't know what happens after Trump's final administration. Or do they get rid of it altogether? And there are some, both on the left and the right, that are all for that. Because remember, this was actually put in by Congress back in, what year was that? I believe it was the 60s, if I remember correctly. Yeah, because basically before, Congress had to separately approve each Treasury debt issuance. And what they created the limit right before World War II. That's what it was, right before World War II, to make debt management easier. But keep the legislature involved with trying to cap the deficit, right? The red ink. And so since then, it's really been kind of a general easy issue to get through, except until 2011. That's really when the fight started over the debt ceiling. And so how effective is it really? It's not really, because this is ultimately, it's not an effective tool that is forcing Congress to cut spending. It hasn't been, despite the political football that it's been. So I think there's Once again, more political brinksmanship here. But what you have to understand when it comes to how this impacts the equity markets or the asset markets in general, a lot of people will think, oh, if we hit the debt ceiling, that's bad. Well, in the long run, if we do default on our debt, yeah, sure, that would probably be very bad. But in the near term, it's actually net positive for liquidity. Why is that? Is because when the Treasury issues debt, they are pulling dollars out of the system. Okay. Now, they counteracts that by taking those dollars and going and spending them, right? That's why they need to issue debt, is because they need to go and spend. Now, when they issue that Treasury debt, it goes into what is called the Treasury General Account, like the Treasury's checkbook. Okay. So what happens in the debt ceiling when they hit it is they can no longer issue debt, means they can't pull any dollars out of the system, but they are continuing to spend out of the Treasury General Account. And the Treasury checkbook, Treasury General Account, starts to draw down, and dollars are going out into the system without any dollars being pulled out of the system either. So that is net positive for liquidity. So that's actually one of the probably strongest arguments for a first half of 2025 being generally a good time in markets. It's probably the best argument because of the new administration, where there's a lot of uncertainty and markets don't like uncertainty, but what they do like is liquidity. And the liquidity situation remains positive. It's been choppier as of late, and you're seeing that kind of in asset markets. But a debt ceiling being hit and the fight being dragged out means a Treasury General account will be drawn down, and that will be net positive for liquidity in the short term. But once that is hit, once they come to a resolution, which they always do, what happens next? They start to issue debt, refill the Treasury General account, and they pull now more money out of the system than they're spending in. And that would be actually net negative, and it would start to balance out. So those are kind of the idiosyncrasies that you, us as professionals, we kind of understand and have to monitor. But I wanted to hopefully explain that to you so you can know how to react to these headlines. A lot of times it's counterintuitive, counter to what you expect would happen in markets. Now we've got time here, so let me drop another question from the InvestTalk YouTube channel. Shane Jacobson says, hey, InvestTalk, could you please go over Cameco, CCJ, and Uranium Energy Corp, UEC. UEC. Let's pull that up here. Now, Cameco, most of you know, we've owned for clients for some time. It's trading around $51 per share. The close yesterday. But UEC, and for everyone, CCJ, Cameco, is a Canadian company. It's one of the largest uranium miners in the Western Hemisphere. But Uranium Energy, this also is a uranium miner. And it has properties in Texas, Wyoming, New Mexico, Arizona, Colorado, and Paraguay. Much smaller, $3 billion market cap versus Cameco at $22 billion. And the earnings are just finally positive for UEC. They're at least expected to be this year. They lost money last year, lost money the year before. They made a little bit, 2 cents in 2022, but it's supposed to make 16 cents this year. It's a $7 stock. So, it's much smaller, not nearly as profitable. Let me take a look at the balance sheets of UEC. I haven't looked at that. Let me pull that up on another system. Yeah, good balance sheet. Yeah, no long-term debt, so that's good. But the free cash flow is negative. Okay. And I'm just going to easily pull up a ratio, CCJ to UEC. And over the long term, Cameco has outperformed, especially since 2022. And it's starting to outperform once again. I rather own the larger, more diversified name with good cash flow. It also, Cameco bought a, was it Westinghouse, if I remember correctly? And so they have a little foot in the nuclear power game as well. So it's not as much of a pure play uranium miner as it once was, but obviously still the majority of their revenue comes from that. So I much rather own Cameco over UEC, and that's why we do for clients and have for some time. Okay. Thanks for the question. There comes another caller question that came in earlier from Michigan.
Jacob from Michigan here. Wondering what you think about MRO, that's Marathon Oil. Thank you so much.
All right, looking at MRO, it's independent exploration and production company, primarily focused on unconventional resources in the United States. MRO, I think Marathon. Yeah, Cameco bought Marathon. And so we like Cameco. So I'd much rather own, Marathon. Like I said, Cameco bought Marathon. And so of the large independent E&P companies out there, Cameco is definitely one of our favorites, has a lot of exposure to natural gas. And so we give Cameco a thumbs up.
I wanted to see what your thoughts were on industrial REIT STAG Industries, ticker symbol STAG. We're looking to get some exposure. Wondering if you could take a look and maybe give me a good entry point. Thank you. Bye.
Ooh, let's take a look at STAG. This is a name that has been on a recent downturn, but a lot of that has to do with the sector as a whole, the REIT sector, because they're bond proxies and they tend to fall when bond prices fall and interest rates rise. And that's what you've seen lately, especially since the election. Now, STAG is an industrial REIT, about $6 billion market cap. It owns 569 single-tenant industrial properties in 41 states, so fairly well diversified there. About a 4.5% yield currently. Last quarter, sales were up 6%. Funds from operation, though, were down 18%. For the full year 2024, funds from operation expect to be up 5% and then another 4% this year. So kind of a steady grower, low to mid-single digits. I think that's fine. It's not exciting, but certainly the type of properties, frankly, I like. I like industrial REITs. I think there's we have some great strengths here in the United States, and one of that is the diverse economy that we have, from high tech to finance to entertainment to industrial companies, from warehouses to distribution centers, et cetera. And that's where STAG tends to operate in. And it has come down. It is into some support here and around the, what are we at, $33.30 at the close. And they have, once again, a good balance sheet. Let me look at its enterprise value to EBITDA is right around 15 times, which is kind of the middle part of its range over the past 10 years. So I would say it's now fairly valued after this decline and into some support. So it's a starter position here. I wouldn't mind it, but I wouldn't go all in at these levels. Now let's talk a little bit. Actually, let's fit another caller question. S. Danko 95 says, what are your thoughts on UFPI? UFPI, I bought this earlier this year at 125 and was up a nice amount, but within the past month, stock is down 19%. Now, well below my cost base. It looks as though support now. Is this hold or should I cut my losses? Manufacture lumber, composite wood, and other building products to the retail, industrial, and packaging industries. Yeah, earnings are expected to be down 15% full year 2024. And this year, supposed to earn $7.31, but that's down from nearly $11 in earnings in 2022. And I think that's the issue is analysts continue to see this name of, see the earnings for this year, expectations come down. You had last quarter revenues down 10%, earnings down 22%. And that looks to continue at least through the first half of this year. But in the back half, you should see some reacceleration. But remember, the farther out the analysts are looking, the less accurate they tend to be. And I do agree that this is worrisome, this recent move down in the stock. Huge reversal, wide-ranging reversal bar last month of December. If I go to a yearly chart, yeah, that's not a good look there. I would move on. I don't think the valuation is particularly attractive, to be honest with you. There's just the multiples are just too high for a business that is struggling, with sales growth. And the good thing is they do have a good balance sheet, but I am afraid that cash flow and earnings are headed lower. So I'm going to say move on, take a small loss, and find something with a much better chart and fundamentals. Thanks for the call, or thanks for the question, submitted via our YouTube channel. Now, lastly, let's talk about creative destruction. And this is one of the terms my grandfather was one of the early terms he taught me about. And it was popularized by an Austrian economist, Joseph Schumpeter, in the 1940s. And it has roots actually in Hinduism, where in Hinduism, it says creation and destruction are considered two parts of a trifecta of equilibrating cosmic forces. And in general, Schumpeter said, creative destruction is central to long-term economic growth and allows resources, capital, and people to be deployed efficiently, effectively. And you would say that is live and well here in the United States. And I would say, yes, in some parts of the economy, that's true. Silicon Valley, for example, I think there's some good evidence there. But if you zoom out, it's not as obvious. If you look at things like job entry and exit rates, it's actually been in decline, which means that people are moving jobs less and less since the 70s. And even in Europe, this is a trend as well. And this decline in creative destruction, I think, has a few forces. And the first is simply, the status quo. There are regulators that provide environmental and social protection for people and companies. You have bailouts, averting financial contagion, for example. And then you have regulatory capture that prevents new entrants from being able to enter and compete at the scale that the current large players are operating at. And you can see this with corporate concentration. The share of the U.S. economy dominated by the top 1% of companies by assets is now above 90%. In the 30s, that was only 70%. And so there's a lot of barriers to entry that these companies are starting to leverage. And part of that is, obviously, like I said, regulatory capture. But the big factor, I think, is actually low interest rates. So for the last decade plus, up until the last couple of years, low interest rates and bailouts have kept companies afloat. Companies that were not very efficient and didn't offer what the market wanted. And these low interest rates allowed them to kick the can down the road and prevent bankruptcy, reorganization, and in some instances, liquidation. And now unprofitable companies in the Russell 2000 make up 40% versus only 15% 30 years ago. So higher interest rates and bankruptcies are actually a good thing for the economy longer term. Well, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and risk and how that relates to your overall goals and risk tolerance level by heading over to investtalk.com and clicking the portfolio review button. This is a free and confidential service. And if you need help with your 401k, we can help with that as well. Just start at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.